All right, I think we'll go ahead and get started. So, good evening, everybody. Thank you so much for joining us for our Credit 101. Hopefully, we have some of you who attended our Money 101, but welcome. I'm excited to present to you guys about what credit is, and I think it's going to be great information. You guys are at the perfect age to start learning about what credit is and why it's so important. So hopefully I'll be able to give you guys that info today. So if you haven't met me yet, my name is Melissa, and I've been with Foothill for over 6 years now. I work in the business development department. It's really fun. It's a great place to work. I have been involved with banking in general for over 10 years now. So learned a lot, and so I'm happy to pass on that knowledge to you guys today. A little information about me. I have my bachelor's in business from Cal State Fullerton. I got my emphasis in entertainment and tourism. And a couple of fun facts about me. I'm a huge movie buff. So I love movies, been watching Netflix shows, love it. Also, I'm a proud dog mama. So that's my baby Pepe right there. He's a crazy little chihuahua. So let's get right into it. So with credit, I think it's really important that we first talk about what interest is. You guys might be familiar with this from my Money 101. We talked a little bit about interest on savings accounts. And we talked about how with savings accounts, you want the highest interest rate you can get. And the main reason is because interest is the percentage that the banks are basically paying you for having a balance, in your savings account. So you're making money, right? It's a little bit more bang for your buck. So with savings, you always want to look for get the highest interest rate possible. With loans, it's different. So with loans, when you're looking at interest, this is actually the percentage that banks charge you for borrowing funds. So when you do like an auto loan or a credit card, you're borrowing these funds from the institution. So when it comes to interest on loans, you want to try and get the lowest interest rate possible. The lower, the better, because that's less money that you're paying back for borrowing the funds. So just remember, try not to confuse them. Savings, you want the highest, and then on loans, you want the lowest. Okay, so jumping right into it. So what is credit? So the actual definition of what is credit, it's the ability to borrow money or access goods or services with the understanding and trust that you'll pay later. So heavy emphasis on trust, guys. So when you're borrowing funds, you really have to be sure to be responsible because it's going to affect you in the future. There's two types of credit we're going to go over. We're going to go over revolving credit, and then we're also going to go over installment credit. So when we were talking about interest, guys, there are two different types of interest that I wanted to focus on. So there is a fixed interest. Basically, what that means is that your interest rate will not change. So whatever interest rate you qualify for, it's going to stay the same for the entire life of the loan. Usually a good example for that is maybe a mortgage or a car. Then you have variable interest. This interest rate can adjust over time. So it can fluctuate and it just depends. It could depend on the market, but a good example of this is a credit card. So whenever you guys do start to apply for loans, be sure to look at what type of interest. Is it going to be fixed? Is it going to be variable? Is it going to be high? Is it going to be low? Be sure to pay attention to those. So the first one we're going to go into is revolving credit. So what is revolving credit? A good example of revolving credit is a credit card. So it's continuous. So even when you borrow the funds and pay it down, you'll still be able to use it again. So with like using credit card as an example, with that, every month that you are using your credit card, you do get a balance, right? So every time you use it, whatever you purchase, all those items, that's going to be your balance of how much you've used on your credit card. And it's really up to you on how you want to pay it back. So you could either pay back the entire balance, before the end of the month, or you can pay off a little bit over time. So with credit cards, that's why people like them, because you can pay it off over time. So a lot of people use them for large purchases, or it could be used for small purchases as well. It's really up to you guys on how you want to use it. It's just important to make sure that you're being responsible when you are using it. But every time you pay your balance down, then it depends if it's going to carry over for the next month. If it does carry over to the next month, then you do have to pay it pay it down that month as well. Also, too, it's important to note that when you do get a credit card, the limit is established by the lender. So it depends on where you go, what institution you're applying at. They all have different factors on how they approve individuals. So you might get approved for different amounts at different places. At Foothill, usually what we like to look at is proof of income. When you are applying for a credit card, we want to make sure that you're able to pay it back, right? Why would we allow you to borrow funds if you don't have the ability to repay it back? So some things that we look at is your proof of income. We'll also look at any debt that you currently have. So there are different factors that come into play on what you would get approved for. I think it's also important to know, especially when you're first starting out with credit, you can request a specific amount, especially for a credit card. Some people start at high limits, like $1,000, $1,500, $2,000. For somebody that's first starting out, I do think that's a little high. Usually for students, I think a good place to start, especially nowadays with the cost of items, maybe between 500 or 1,000. I know I used my very first credit card when I was going to college, to pay for my books, to pay for parking, to pay for food. So you can choose how you want to use it, but just make sure that you don't get too high of a limit. You don't want to dig a hole for yourself, especially if you're the type of person that maybe might use it a lot, maybe not be, might not be as strict with it. So just be really careful with that. With revolving credit, with credit cards, just remember that the interest rate can fluctuate. Okay, so it can change over time. Also, to your payment. So with a credit card, you're always going to have a minimum payment if you have a balance on the card. If you have a balance on the card, which means you've used it, then you will have to at least pay a minimum amount each month until it's paid off. That minimum payment can fluctuate. It can depend on what your actual balance is. Typically, if you have a pretty high balance, your minimum payment is going to be pretty high as well. But it can vary. I've seen it as low as $15, as high as $300. It just depends, but just be sure to always make your payments on time. If there is one thing that you can take away from this entire presentation that I'm repeatedly going to tell you guys is please make your payments on time. That's probably the most important thing to take away from here, especially when you're first starting out with credit, when you have your first credit card. Always make your payments on time. It's also important to note that there are late payment fees. So if you do miss your minimum payment due date, which you always have a due date and the due date will always be the same, if you happen to miss that, there can be a late payment fee. So that's why it's really important to utilize automatic payments. You can set up your checking account to do an automatic payment if you know that maybe you're not the type of person who can stay on top of it. But there's multiple ways to make sure that you do your payments on time. So always pay attention to that because you don't want to rack up those fees and because that can hurt your credit score, which we're going to talk about a little bit in the future. So here's to give you a little bit more of a visual example about credit cards. So let's say you get approved for a credit card here at Foothill and your limit is $1,000. That means the maximum that you can spend on that credit card is $1,000. Let's say you do some purchases, maybe one big purchase. Let's say you buy some new shoes, right, for $100. So now you put that charge on your credit card. That means now your balance, the amount that you owe on the credit card, is $100. So that's basically what you would have to pay off. With credit cards, like I said, you also have a minimum monthly payment. And this is with every single credit card. You're going to get a statement, and that's going to show you all of your transactions. And it's also going to show you your minimum monthly payment. So for this example, let's say our minimum monthly payment is $25. So that's just the minimum that you have to pay for the month. So your total balance is $100. If you want to, you can pay that $100 right off, or you can choose to just do the minimum monthly payment. Just make sure that you do it on time, once again. And I always recommend try to do it before your due date. You don't want to leave it to the last minute because life happens, emergencies happen. Maybe you'll forget. So it's always good to plan ahead. So I think it's really a good habit to make sure that you pay it before the due date. But like I said, it's your choice. It's really up to you if you want to just do that minimum amount or pay off the entire balance. Next, you want to also look at the interest that you get charged for the month. And it's important to note with credit cards too, you will only get charged interest if your balance actually carries over to the next cycle. So if you paid off this $100 balance before the end of your cycle for your credit card, then you would not get charged any interest. But if you only did the minimum monthly payment and then you let the rest of the balance, the rest of the $75 carry over to the next cycle, then you'll get charged the interest. And for this example, let's say $5. So now your new balance is going to be $80. So just be really careful with that. Interest can be a pretty big charge or it can be a small charge. It just depends, but it's always important to look at what it is each month. And that's why it's important to try to get the lowest interest rate possible because that's less money out of your pocket. So like I mentioned earlier, with credit cards, you will get a credit card statement. And there's a lot of information that's on this credit card statement. It would be a good habit for you to actually look at it and read through it just to see it. Some people do, some people don't, but it has a lot of information. So typically on the credit card statement, you should be able to see either your account number or your credit card number. For security purposes, it won't have the full account number. It typically will just have the last four numbers, but that's still good for you to see just to make sure it's the right statement. It's going to have your statement date and your statement closing date. So basically, I kind of talked about your billing cycle. So this billing cycle is the 30-day period of where your purchases are being made. After that billing cycle, that's usually when they calculate what your minimum payment will be, and it'll be due the next month after that. So for example, let's say your statement date ends on January 22nd, okay? That means your minimum payment most likely will be due that next month in February, and you're basically paying down last month's purchases. So some people think that, the end of your statement date can be your minimum, your minimum monthly payment, but that's not always the case. Just because let's say, for example, if your minimum monthly payment is on the 31st of the month, that doesn't mean any purchases after that are going to go on to the next cycle. You have to look at specifically at your statement closing date. That way you can look at exactly which cycle those transactions are from. But once again, just make sure that you always make that minimum payment on time. It's very important to look at those dates. They actually mean something. Also, you're going to see your credit limit, which kind of the example we saw before. That's the maximum that you can spend on your credit card. It is your responsibility to make sure that you don't reach the max. You don't want to max out your card, is what we say, is when you reach the maximum limit, because it might be pretty hard for you to pay that down. Obviously, emergencies happen, but just do your best not to reach the max. And then you'll see your available credit. That's basically the amount you have left to spend. So it's your balance minus it's your limit minus your balance. It's kind of in the name, it's what you can still spend. Something else that's really cool on your statement that you're going to see is your repayment calculator. So this basically shows you an estimate of how long it'll take you to pay off your credit card if you only pay the minimum monthly payment. So for example, let's say I have a credit card balance of about $1,700, right? And the minimum payment is only about $53 or $50, $53. It'll show me a calculation of how long it'll take me to pay off that credit card if I only do the minimum payment, but also if I do not do any more additional transactions or purchases. I don't know if you guys can guess in your head of how long that would take if you have about 1,700 and you're only paying about $50 each month. The average, it'll probably take you about 8 years to pay off. So it's a really long time. And interest alone, you have to remember too, each month it's going to be adding interest onto your credit card, so you're going to end up paying a lot more than just that original 1,700. So you're not just going to be paying it down, you're also going to be paying it down plus adding interest. So be really careful with, when you guys are paying back, doing your minimum payment. Try to do more than the minimum, but like I said, it's really up to you. You're also going to see total interest rate or interest charge. So basically, you're going to be able to see your total interest and fees for the whole year. And that's really good to look at because you really want to pay attention to how much interest you are paying. And like I said, once again, that is just why you want to try to get the lowest interest rate possible, which credit unions are known to be very competitive about that. We have pretty low interest rates compared to banks, so that's a plus. So we have our very first knowledge check question. So let's see if you guys are still awake, still paying attention, hopefully. Which type of interest rate can fluctuate? So if you want to go ahead and use the chat box, you can put your answers there, see if we have anybody that can answer it. If not, talk amongst yourself and see if you know the right answer. Also, too, if you do think of any questions, feel free to put them in the chat box and we'll go ahead and address them at the end of the presentation. I do see some answers coming through, so that's good. You guys are awake. So I'll leave you the suspense no more. So which type of interest rate can fluctuate? The answer is variable interest. Okay, so we talked about revolving credit. Now let's get into installment credit. So installment credit works a little bit differently. A good example for this one is a house. It's also known as non-revolving credit. But basically for installment credit, it is for a set period of time. It's a specific sum of money that you agree to repay. Don't forget, you also have to pay interest and fees with this, but you're gonna pay it in equal monthly payments. So it's a little bit different than a credit card. They usually have a fixed interest rate, meaning the interest is not going to change. Also, too, your payment will not change for the entire life of the loan. So if you're thinking of a house, a mortgage, usually a mortgage is about 30 years. And for that entire 30 years, your mortgage, your monthly payment is going to be exactly the same every single month. But once again, make sure you do your payments on time because even with installment credit, there are late payment fees, and they can be a high amount, especially depending on the loan. Just be really careful about that. And then it also, like I said earlier, it's going to affect your credit score, which we're going to talk about a little bit later, but that's installment credit. So another example of installment credit, this one might be a little bit easier, is a car loan example. So let's say you get approved for a car loan. The loan amount is about $30,000. So this is what you guys are going to see. Let's say your term is about for 5 years. That means your payment will come out to $550 every single month, and your interest is already calculated into that payment, so you don't have to worry about any additional charges. It's already calculated all together, and your interest is about 3.7%, which is pretty good. That's a pretty low interest rate. So this is just an example just to show you guys what it might look like. Okay, so now that you guys know exactly what credit is, I'm going to go into why it's important to build good credit. Not just building credit, not just being responsible, but being building good credit is so important, and especially at such a young age, if you start being responsible right at the beginning and stay on top of that, life is just going to be so much easier for you guys. So here are some examples, of why you want to build good credit. So something that people don't realize, when you are apartment hunting, they do run your credit. They check to see how trustworthy you are, because that is a way to see it. I like to tell people credit is almost like your grade in life. So it has a lot to do with your future. So once again, it's really important that you guys are being responsible. But when you are apartment hunting, let's say if the decision is between you and one other person, you make the exact same amount of money, you both have great references, you both have great history from renting from previous people. So what they're going to do is they're going to look at your credit. That's going to be a way to see how trustworthy each of you are. And maybe one person has a higher credit score than the other, then guess who's going to get that apartment? The person with a higher credit score. So make sure you guys consider that. Also with buying a car, when you guys buy your car for the very first time, especially if you're just starting out, you might not have credit established just yet, but if you do, that's going to give you so much bargaining power, because typically people who have lower credit scores, they're going to have to take higher interest rates. They might have more fees that are applied to there, or might be more restrictions when they get their first loan. And unfortunately with dealerships, they could possibly take advantage of you, especially if they know that you have a low credit score. They know you're desperate and you'll say yes to anything. So if you do have a higher credit score, that just gives you much more power. And then also, I just wanted to make sure you guys know that when you do start your auto buying journey, you can start that at the credit union. A lot of people think you have to automatically go to dealerships, but you can actually start at the credit union, see what you get approved for, especially if you already have an account with us and you have a history. It's great to your first stop to be at your credit union. Also, why build good credit? Credit cards. Like I mentioned earlier, you want to get the lowest rate possible. And if you have a good credit score, then you're most likely going to get approved for a lower interest rate. So you want the lowest interest rate possible with credit cards. And then lastly, student loans. When you guys do have a high credit score, you're most likely going to get approved for larger amounts. So it'll benefit you, especially if you're planning to go away for college and you need more funding for that. Having a high credit score, having good credit is really going to help you. So these are the 3 credit bureaus. There is Equifax, Experian, and TransUnion. A lot of people think that there's only one credit bureau because they kind of associate you just have one credit score, but you actually have 3. You have a different credit score for each credit bureau. However, they're not too far apart from each other. They're usually around the same range. And the only reason that they have different credit scores for you is that they just have, different lenders report to different credit bureaus. So they might have different algorithms on how to calculate it, but usually they're around the same number, not too far apart. But fun fact is a lot of people think you only have one credit score. You actually have 3 from 3 credit bureaus: Equifax, Experian, and TransUnion. So what's on your credit report? So how I mentioned, your credit score is like your grade in life. Think of your credit report as like your report card, right? So this is where it's going to have all of your history. So anytime you apply for a loan, this is what the lender is going to see. This is all the information that they're going to see. And when they're deciding whether to approve or deny you, this is what they're going to go based off of. They're going to be able to see identifying information. And this is for security purposes. We want to make sure you are who you say you are. So something they're going to be able to see is your social security number, your date of birth. They're going to be able to see your current address, and they might even be able to see past addresses. And at times as well, they're going to see your employment history. So a lot of people don't realize this, but employers do have the ability to run your credit as well. And once again, it's just a way to see that you're trustworthy. Maybe sometimes the job that you're applying for needs to make sure that you have good credit, or really needs to make sure you're a trustworthy person. So they are going to be able to see employment history if they run your credit report. So not that you guys would ever lie, but just want to make sure you don't lie on your resumes. They're also going to be able to see opened and closed accounts. By accounts, I don't mean like checking or savings. These are loans. So any type of loans that you've had in the past, they're going to be able to see if you still have them open or if they're closed, paid off. It's very specific. It's very detailed. And they're going to be able to see what types of loans are they? Are they credit cards? Are they mortgages? Are they auto loans? They're going to be able to say if you've been paying on time. And like I said, it's very detailed. So they're going to be able to see, have you been on time for the last 30 days? Have you been on time for the last 45 days? Have you been late once? Have you been late twice? It's very detailed. So they are going to be able to see all of this information. Usually with late payments, though, there is a fee for that. However, it is important for you guys to know that late payments usually don't get reported to the credit bureaus unless you are 30 days or more late. So if you ever are late on a payment, it's going to charge you the fee, but you still want to try to do that payment because that could save you from it getting reported on your credit report. Okay. They're also going to see collection records. So any unpaid loans that you have, any loans that were closed and you never paid them, they're going to be able to see that negative history, and it does stay on your record. You want to make sure that never happens to you guys, because it is a way to show that you're not trustworthy, and that can keep you from getting approved for future loans. So that's why it's important for you guys to stay responsible from the very beginning. Also, they're going to see inquiries. What an inquiry is, there's two different types of inquiries. There's a soft inquiry and a hard inquiry. And this is an inquiry is anytime somebody accesses your credit report or they pull your credit. So a soft pull is usually used when it's somebody's just trying to identify you. So like if you're opening an account, at the credit union, we do a soft pull on your credit report, and it's just for that identifying information. So it does not affect your credit score. Versus a hard pull. A hard pull is when they actually want to view your credit score, and it's going to impact your credit score. Inquiries usually stay on your record for about 2 years, but you just want to be really careful with inquiries because you can get in trouble if you have too many, which I believe we're going to talk about a little bit later in the presentation. But anytime somebody says like, oh, we're going to pull your credit, make sure you ask them, is this a soft pull or a hard pull? Hard pulls typically when they want to do loans. So if it's a loan, they're most likely going to do a hard pull. So always try to ask if anybody tells you that, just so you can make sure, like I said, soft pulls, they will not hurt your credit score. So that's the one you want to be okay with. Hard, you want to be a little bit more reserved with those. Also too, on your credit report, you can, there is a section called the consumer report. And this is basically where you can add a statement on your credit report. So if you have had any negative history, maybe you could explain it in the consumer report of why, why did you default on that loan? Why you've had all these late payments. Also, a lot of people use it if they ever have identity theft. So if somebody steals their identity, they'll put a warning on the credit report, something along the lines of, if my credit is ran, please call this phone number, and it's usually their direct number. And then if anybody runs their credit, they're going to see that warning, and they're going to have to call that person to verify. So it's really up to you if you want to use that. It's optional, but it can be used for the good if you do have any identity theft in the future. And there's no cost to it. I believe it's free. So now we're going to go over your credit score and the credit score range. So like I said, your credit score is your grade in life. So this is kind of looking at your A grading all the way to F, if you're thinking about it with like school. So your credit score is actually a 3-digit number. And like we said before, it reflects how trustworthy you are. The higher your credit score, the better. This is going to show the lender that you are a low risk and that you're trustworthy and that you're responsible and you'll be able to pay back your debt. The lower your score, the higher the risk you are. And you're going to have a higher cost if you borrow money, because the higher your credit score, the lower your interest rate is going to be. You're trustworthy, so they're going to give you a pretty low interest rate. If you have a pretty low credit score, you'll most likely get approved for a higher interest rate, meaning you're going to pay back a lot more money. So like I said, it's really important that you guys start right at the beginning being responsible. Something you also want to know is what a FICO is. So FICO is the most widely used scoring model. Basically, what this is, it's an average, a good way to explain it, it's an average of your 3 credit scores. And typically lenders will pool your FICO. This is a way that they'll be able to assess the risk, of lending you money. Instead of pulling each one of your credit scores, at times they could choose to pool your FICO. Just remember, because I know a lot of people confuse FICO with an actual credit score, but FICO is just an estimate, but it's usually not too far off. So I know a lot of, if you guys see those credit monitoring services, they sometimes say they'll give you your FICO score. So that's just an estimate of where your credit score might be. So it's still good to keep an eye on, but it's just mainly a scoring model that a lot of lenders and a lot of institutions use. So the number one question I get when I'm on this slide talking about your credit score is, where do students land? Where does somebody who has never had credit, where do you land on this scoring model? And really, a lot of people think you start at the bottom. That's not true. You start right at the middle, right between good and fair, because you really haven't done anything negative, and you haven't added any positive to it. So you start right at the middle. So it's really up to you to stay on track and to be responsible to make that credit score go from fair all the way to excellent. And just like in school, guys, it's easier to stay on track and do your homework and get good grades, right, than it is to fall behind, not turn in assignments, and then at the end of the year, you have to work 10 times harder doing extra credit to up your grade. So it's similar to school. Just stay on track, stay responsible, and work towards excellent. Really work towards that 800 credit score. So how is your credit score calculated? So these are the main factors when looking at how your credit score is calculated. So once again, relating it to school, these are, you want your grade at the end of the year. This is how they calculate your grade. So the biggest chunk, which is why I have repeatedly told you guys that the most important thing is to do your payments on time. The biggest chunk is payment history. So this is the largest impact on your credit score. It's 35% of your credit score. Making your payments on time is just going to show them how responsible you are paying off debt. So like I said, the number one thing to take away today is to always make your payments on time, because it's the biggest chunk of your grade. Next is amounts owed or use of available credit. This is only 30%, so not too bad. It's basically how much debt do you have, how much credit is available to you. A good rule of thumb that I like to tell people is only use 30% of your available credit. So if you have $1,000 limit on your credit card, a good rule of thumb is try not to go over $300, just to keep it manageable for you guys. But they are going to look at how much debt you have. Next, 15%, so it's a lot lower, is length of credit history. So once again, it's not too big of a chunk. This is how long have you had credit? Because obviously the longer you've had it, the more experience you have, especially if you've been responsible, that's the longer you've been trustworthy. You've built up that trust over those years. So length of credit history is another factor they look at. Next is types of credit used. So what kind of credit do you have? Do you have all credit cards? Do you have an auto loan? Do you have a mortgage? Once again, this is a smaller percentage, 10%, so not too high. Basically, it just shows how good you are at managing different types of credit, because I can tell you from experience, just because you're good at managing a credit card does not mean you will be good at managing an auto loan. They're very different, have different payment amounts, different terms. So types of credit is just going to show them how responsible you are at managing different types of credit. Lastly is new credit, which once again is a small portion. It's only 10%. But I find that this is really important, especially to students or to people first starting out with credit. It's really in the name. It just shows how often you've applied for new credit or new loans. But the reason why I feel like this one's important, because a lot of people get in trouble with this one, is if somebody's applying for too much credit constantly and getting decline, this can hurt you, because like I mentioned earlier, when you apply for credit, you are going to get a hard inquiry, a hard pull, and that's going to hurt your credit score if you have multiple hard pulls in a small amount of time. So I always like to tell students that when you are applying for a credit card, if you do get declined, stop right there. Figure out why. Ask the institution, what are you missing? Why is the reason you got declined? And they should be able to tell you. They can tell you it's because you don't make enough income. They can tell you, maybe there's something wrong on your credit report that you need to fix. They'll let you know. But just be really careful. Don't constantly keep applying for credit if you get declined. The only time when you are able to do this is when you are shopping around for a car. So that's a good example to use of where you are allowed to apply multiple times. So usually with a car, you are allowed to shop around for the lowest interest rate. So you can apply at your credit union, you can apply at the dealership, and they're all going to pull your credit report and look at your credit score. But what the credit bureaus do is as long as you do those inquiries within a 30-day period, they'll count all of those inquiries as one. And the reason is because they're going to be able to see that they're auto inquiries. When we run that inquiry, it's going to say Foothill Auto Loan. When the dealership does, it's going to say Toyota Auto Dealership. So they're going to know that it's for shopping around for a car. Also shopping around for a house too, you want to try and get the lowest interest rate, but just be really careful with new credit. It's a small percentage, but like I said, with younger people starting out with credit, it can get you into a lot of trouble. Next knowledge check question. Let's see if anybody knows this one. Hopefully it's a little bit easier. What are the 3 credit bureaus? I know their names were a little tricky, but hopefully we have a couple of people that can get in that chat box or maybe talk amongst yourselves and see if anybody remembers those 3 credit bureaus. I know maybe it is a little bit more tricky than the first one. I see a couple of answers coming in, so that's good. So what are the 3 credit bureaus? There is Experian, Equifax, and TransUnion. So remember, guys, there are 3 credit bureaus, 3 credit scores. Good job if anybody got that one. So next, I'm just going to go over an example, right? So this is to show you guys that it can depend, there's a lot of different ways to look at things, but we're going to show 2 examples. So we have Melissa and Stacy here. So we're going to try and guess who has the better credit score. So Melissa has a credit card with a balance of $800. Her limit is $1,000, okay? It's pretty high. And she pays more than the minimum. Versus Stacy. Stacy has a balance of $5,000, so she owes a lot more, but her limit on her credit card is $10,000. But Stacy as well pays the minimum. So just thinking to yourselves, amongst each other, who do you think has the better credit score? So if we're looking at everything, the person that's most likely going to have the better credit score is Stacy, which might be a shock to some people. Despite Stacy having a larger balance and owing more, I don't know if you guys can look at or can think of it right away of what's the main reason why Stacy is above Melissa. Because if you look at it, they both pay their minimum payment on time. So they're kind of the same when it comes to doing their payments. So what's the next thing that the credit bureaus look at? The amounts owed, how much do you owe? So even though Stacy does owe more than Melissa, technically she's only utilizing about 50% of her total credit limit. So if you guys remember, my rule of thumb was try not to spend more than 30%. Versus Melissa, even though she's only at 800, she's almost at 90% of her credit limit. So she's a little bit more in trouble. So if Melissa were to pay down her balance, though, and kind of maybe get below that 50% credit limit, or below, even better, below 30%, that would drastically increase her credit score. So remember, there's different factors, but it really just depends. I think an important thing to look at, though, is they both do their payments on time. So most likely they're both still going to have pretty good credit scores. It just might be the case that Stacy has it a little bit higher because she's being a little bit more responsible. Because if Stacy wanted to, if she paid down that, then she wouldn't have such a high balance on her credit card. But it just really depends. So main thing to take away, once again, always do your payments on time. So here's another example we want to go over, and this is a fixed rate example. So looking at more like a mortgage. So we have Melissa and Stacy again. So Melissa's credit score is 650. So this is going to show you guys how your credit score really affects your loan. Stacy's credit score is 750, so it is much higher than Melissa's. But because of their credit score, Melissa's interest rate she got approved for a 5.1%, versus Stacy got approved for a 3.1%. So since she has a higher credit score, she got approved for a much lower interest rate. Melissa still got approved, but it's a higher interest rate. So with that credit score and that interest rate, Melissa is looking at a monthly payment of $2,715. Okay, so about $2,700 for her mortgage, versus Stacy. Stacy actually got her monthly payment down to $2,135, so about $2,100. So Stacy is saving a lot more each month, thankfully, because she has an amazing credit score. But now let's look at total paid overall. So over the entire life of their loan, total paid overall for Melissa, because of her low credit score, she's paying over $900,000 for her mortgage, versus Stacy. Let's look at Stacy's. Wow, much lower. Hers is about $760,000. So Stacy is in a much better position. Look at that. That's saving almost over $200,000 difference for Stacy. So once again, you guys, just showing you why it's so important to have a high credit score and really pay attention to what interest rate you guys qualify for. Okay, so for you guys starting off as students, as young adults, where do you start? How do you build good credit? So my recommendation is to always start with a small credit card, a credit card with a low limit, something that you think is going to be manageable and that you could be responsible. Okay. Like I mentioned earlier with Foothill, I would say a good limit to start at is around $1,000, maybe $500 if you feel like that'll be too tempting for you. But with the cost of life nowadays, I think $500 to $1,000 would be a good credit card limit for you guys to have. But also remember the different factors that come into play if you get approved for a credit card. At Foothill, we do like for you to show proof of income. So if you're working, do you have a job? That's going to be a huge factor on whether or not you get approved for a credit card, but also whether you should even get one, because you as an individual, you should not be applying for loans if you don't have a way to pay it back. So if you're working and you know you'll be able to pay it back, that's a huge plus. So it really just depends. Be really careful with store credit cards. I know a lot of students sometimes turn to store credit cards, but be really careful because their interest rates are a lot higher than you'll find at the credit union, which we have learned that's going to be a higher cost for you guys. Also, too, with store cards, remember, not all of them are Visa or MasterCards. Typically, you can only use them there at that store. So if you're getting like a Forever 21, you know, you're only going to be shopping there buying clothes, but you really want a credit card for everyday life purchases. Like I mentioned, when I got my first one, it was for college, for buying books, buying food when I was on campus, for paying for my my parking fee. So it really just depends, but look at the credit card that you're getting approved for. Do your research, you know, look at what benefits come with it. You know, we have rewards credit cards here. So you earn rewards points and get to redeem those for really cool stuff at the end. So look at, definitely look at that when you guys are picking your credit card. So some of you might be asking, you know, what if I don't have a job? What if I'm not working yet, but I want a credit card, or my parents want me to get one? Something else that you can do is you can actually get a cosigner for when you get your first credit card. It's important to know that if you do get a cosigner, if you were in My Money 101, you learned about joints on accounts and how the responsibility lies with both. It's the same for a credit card. If you have a cosigner on that credit card, you are both liable for those charges. You will both be held responsible for that credit card. So make sure you get somebody that's trustworthy. You could try your parent or a guardian, but just remember that whoever you choose, if something goes wrong, it could jeopardize your relationship with that person. So just make sure to really put thought into if you do decide to get somebody who's a co-signer, because a lot of people, when you get your parent, you're kind of piggybacking off of their credit score and their income if you don't have any. So maybe for your parent, they're the ones that want to be careful because they need to make sure that you're going to be responsible. But at least they'll be on the credit card with you so they can watch you and make sure you are being responsible. So that'll be a plus if parents are listening. Also, too, another thing you could do is add as an authorized user. This works a little bit differently than a cosigner. This responsibility relies more on your parents. I know I always recommend this because this is something that my mom did for me, which I found very helpful. Basically, what it was is she added me on as an authorized user to her credit card. So not necessarily I'm applying for my own credit card. I'm basically being added to hers. Something about this, though, is with authorized users, you are not liable for any charges. So for me, when I was on my mom's credit card, I got my own with my own name, but it was technically her line of credit. And I could do purchases, I could go out shopping or use it for whatever I needed, but she would be able to watch me. And the other thing about it, though, is I'm not liable. So I technically didn't have to do payments on it. If I didn't want to, she would do that. But if she wanted me to, obviously with that relationship, she can show me and teach me how to do payments. So I could. So this is a good way to be added to gain that extra history. But it's important to note that with being added as an authorized user, it does not establish credit history. So for parents, if you're listening, it won't establish credit history for your child, but it will just give, it will show up on their credit report. It's just not going to affect their credit score. But it is a good tool to use to help teach them. So it's another thing I like to bring up because, you know, my mom did it for me and I found it very helpful because I was responsible. Lastly, something else you can do is get a secured credit card. So secured credit cards work a little bit differently. So this could be for somebody that maybe they don't have the best credit and they're trying to build it, or it could be for a student who doesn't really have any credit and they want to build it. Basically, an easy way to explain this, it's kind of like a prepaid card, I guess. So you are required to deposit funds first before getting the credit card. So for example, let's say if you want to get a credit card for $300 and you decide to get a secured credit card, the institution will first ask you to deposit $300. What they're going to do is they're going to put that $300 on hold. Okay, now that we have that hold, we are going to issue you a credit card and you will be able to go use that credit card, do purchases, do transactions. However, as you start using that credit card and create a balance on it, you will still have to make minimum monthly payments towards it, just like a regular credit card, even though you deposited money into this savings account where we're holding those funds. And the main reason is because just in case, if for some reason you choose not to be responsible or you default on the loan, the credit union is covered. We have the $300 there. So it's not really a high risk for us. But also on the plus, it allows you to establish credit history and to show us that you're being responsible. Usually with secured credit cards, you're not supposed to stay in them forever. I think we recommend that you keep it for 6 to 12 months. After, as long as you showed a positive history, showed us you were being trustworthy and responsible, then they just upgrade you into a regular credit card. So still, it is a good way to start establishing credit. So next, I think this is a really good knowledge to have is how do you view your credit report? So nowadays there are a lot of credit fixers out there or credit tracking. So it's important for you guys to know though, you can get one free credit report from each credit bureau. If you go to annualcreditreport.com, you can actually get one free from each credit bureau each year. So that means you can technically get 3 a year. But if you use annualcreditreport.com, it's only going to show you your credit report, not your credit score. If you want to see your credit score, usually they'll charge a small fee for you to see it, but at least it would be fun for you to look at your credit report just to see what's on there. You know, to also too, it's a good security precaution to make sure that nobody's been using your social or nobody's stolen your identity. But it is good for you guys to utilize. If you do, I always recommend pulling one credit bureau at the beginning of the year and then maybe one credit bureau in the middle of the year. Do leave some cushion because if you pull them all at the same time, you're just going to see the same thing. So you can pull them throughout different times in the year. I was going to note though, if you are a member with us and you have the Protection Plus checking, just know you are able to see your credit report for free. And I believe they even show you your FICO score. So any student that has this account, if you're under the age of 21, it's completely free for you. You're able to see that information. So double check that you have the Protection Plus checking. And if you do, just know that you do have that benefit. You're able to see your FICO score. So if you look on the screen, this is kind of an example of the way one looks. So you'll be able to see it's your Experian score and it's 769, which is not too bad. And so it kind of lets you know where you're at. And I believe there's different times in the year where you're able to see it change. So look into our Protection Plus checking if you guys have it. Ooh, another knowledge check question. So let's see how many people are able to get this one. We talked a little bit about it earlier, so it might be a little bit harder. What is the most used scoring model? See if anybody remembers that one. Anybody? It's a really short word. Hopefully I see some comments coming in. Might be a little bit harder. It's a really weird word if that helps you guys. So what is the most used scoring model? The answer is your FICO score. So hopefully some people got that one. Good job if you did, because that one was hard. We did talk a little bit about identity theft, but I want to make sure that you guys have all the knowledge of credit, but also realize why it's so important to protect your credit. Be aware of fraud. There are a lot of fraudsters out there nowadays, guys, and they're getting smart. They're very tricky. So just be really careful. And it's important for you guys to know, if you attended my Money 101, you know this, but students are one of the most targeted groups of fraud. So young adults. So be really careful because you guys don't have the knowledge just yet. So you might be easily tricked. So it's really important that you guys look into different types of identity theft protection, like I mentioned. we have our Protection Plus checking. It's really cool because it does give you a notification every month, if everything's all good with your credit report, which I really like. So it's really cool. So look into that. Like I said, if you're under the age of 21, it's completely free for you. If you're over that age and you have the Protection Plus, it's a low monthly fee of $4.95. Not too bad when you look at that compared to other identity theft protection costs. Some places I've seen as high as $20 a month. So $4.95 a month is not too bad, but really look into that and just pay attention. Make sure you keep your social security number safe. Monitor your credit, utilize annualcreditreport.com. Like I said, you guys, read through all the information, make sure that it is you that has done everything on there. Add alerts. That's a really good one. I mean, nowadays with technology, you can add alerts on your mobile app. You can add it for your online banking. It'll alert you if somebody, runs your credit. That's really important because if you're on vacation in Hawaii and you get a notification that somebody in California ran your credit, it's not you. So adding alerts can be a huge benefit, not even just for your credit, but also your accounts. If your balance is getting low, maybe a reminder on your minimum monthly payment. So there's a lot of things that you can utilize. Shred sensitive information. So this is really important, you guys. Make sure anything that has your social security number or even your address on it, any of your card information, make sure you shred that. A lot of places are able to do paperless. So if that's better for you, maybe opt into that to receive electronic statements instead, but really pay attention to what you're throwing in the trash. Something cool that we have at the credit union, we have shred days where we allow our members to bring, I believe it's 2 bags of trash. And instead of you having to sit there, shred all your paper yourself, you just put them in the bag and then you come to the credit union, drop them off, and we shred them right there in front of you. So it's a free event for all of our members. So if you haven't attended one, look up, we do have some throughout the year. But those are really good to get rid of those sensitive material papers that you guys might have. And then lastly, guard your information online. I know nowadays with young adults being so tech savvy, you're always online, you're always on the internet, but just be really careful. Something to know is beware of public Wi-Fi. That is an avenue that fraudsters use to hack into your accounts, to hack into your phone, to your laptop. So, I mean, I know sometimes that's convenient for you, but it's not always the most protected way to go about it. So be really careful with public Wi-Fi. Be careful with phone calls or emails that might be potential scams. I know I get phone calls saying there's a warrant out for my arrest. I've gotten that I owe the IRS some money. There's a lawsuit against me. These are scare tactics. They want to scare you so that you'll call them back. And you know what? The first thing they're going to ask you is, what's your social security number? So once they get that information, they're golden. Then they'll try and get more information from you. And because you're scared, they typically bank on that you're just going to give them everything they want, which at times people do. So be really careful with emails. If you get an email from somebody, you don't know that person, don't click on any links on those emails. If it looks fishy, it probably is. It's better to just call the person. Sometimes they'll pose as people so be really careful, especially if it's ever asking for money. If it's ever asking you to send money, it's an emergency or something, call the person, talk to them in person. I highly doubt, if your mom was really desperate for money and it was emergency, she would not send you an email. She probably would call you and talk to you over the phone in person. So just be really careful, use your best judgment, like I said, because you guys are one of the most targeted groups. But yeah. So that's pretty much it. We're just wrapping it up. We're pretty much done with our presentation. Don't forget, guys, if you're not a member yet, you do qualify for membership. I highly recommend joining the credit union. All you have to do is start your savings account with $5, and it's free for our youths. It does depend on your age on which one you get put into, but we have different, these are just 2 of them. We have more than that. Also, too, if you open an account, if you open a youth account in the month of April right now, you are entered into a contest to win 4 Legoland tickets. Also, too, you'll get a really cool Lego piggy bank. So I highly recommend, if you're not a member yet, to join. If you are a member, don't worry. You can still participate in the contest. If you open a youth certificate, which is a really great savings tool, you also could be entered into the contest to win the 4 Legoland tickets. So we're here, guys, if you need any help, if you have any questions. I think I'm gonna turn to Stacy to see if we had any questions.
We do have a couple questions, and we also have an attendee that has her hand raised. So I'm gonna let Karen ask her question, and then I'll go to all the questions in the chat box. So Karen, I have allowed you to talk, so you can ask your question to Melissa. No.
Maybe use the chat box, Karen, if you're not able to unmute yourself.
Okay, well, while we're waiting for Karen, let's go to some of the questions that you have. So the first one was, how bad can missing one payment mess up your credit?
That's a really good question. So like I mentioned earlier, if you miss a payment, don't get too worried because typically the lenders don't report late payments to the credit bureaus until they're 30 days late. So like I said earlier, even if you miss your minimum payment by a day, it's the next day, don't ignore it. Still go and pay it off. You're going to get charged a late fee, but still pay it off because then that won't get reported and it won't hurt your credit score. But you know, if it happens every once in a while, you won't see, if let's say if it does happen and it does get reported, you're not going to see a huge drop in your credit score. It's really if it's something that's consistent, but you don't want to get to that point. You want to make sure that you're always doing your payments on time. And like I said, it's better to utilize some of those alerts or paying it before the due date so you don't get to that point. But if it's just one, you don't have to be too worried. It's not going to hurt it too bad. It's mainly if it's consistent and you're always late, you know, on your payments. But definitely, even if you're late, pay it off. Do the minimum monthly payment. That's a good question, though.
Okay, the next one, I believe this is when you were talking about cosigners, because it says, would it affect your parents' credit score?
Yes. So with the cosigner, remember you are both liable for those funds. So not only is it going to affect your credit score, but it will affect your parents, which is why sometimes the parents are a little hesitant because, you know, if you have your kid, you don't know how responsible they're going to be. But if you're going to add your child as a cosigner, you have to remember you as well have that responsibility to watch them and to make sure that they are building good habits. But yes, it's going to affect both the parent and the child. So hopefully the child, you're teaching them to be responsible and making those payments on time to where it will just work in their benefit and help build to their credit. But don't be scared. You know, I still think that it can be a good process, a good way for your child to build their credit. It's the authorized signer is where the only person that's liable would be the parent. The child is not liable. But yeah, with the cosigner, your kid is basically piggybacking off of your credit score and your income for them to get approved.
The next question is, so how would you bring yourself up from extreme bad credit, like rock bottom?
That's a good question too. So there are a lot of programs you can utilize. So here at Foothill, we do have a vendor we use. They're called GreenPath. They're a financial counseling vendor that we have is a good way to put it. So if you do have really bad credit, they can come up with a plan for you. So there's different things you can utilize. Also too, we have a credit builder credit card. It's specifically for people that have challenged credit. And that one is more like the secured card that we talked about, where you do have to deposit funds first in order to get that credit card. But it's really about being responsible. You're going to have to start all the way from the bottom and start doing small payments. Hopefully you get approved for a credit card or a credit builder to where you can show that. It is going to take some time, but it is very hard. It's extremely hard. And like I said, it's going to impact your future. So let's say if you hit rock bottom right when you're 21, when do you typically buy your first car? When do you typically buy your house? It's when you're much older. So you're starting out horribly. You don't want to do that. So that's why it's so important for you guys to stay positive, stay responsible from the beginning. But thankfully, we do have counseling services that you could utilize if you do hit rock bottom, but there's a lot that goes into it.
So another question says, so I want to buy a car. So say I want to buy a car, but I'm new to credit. Can my parents purchase my car?
So you want to buy a car, you're new to credit. I mean, of course, yeah, if your parents want to be awesome and buy that car for you, they can go ahead and do the loan. Obviously, the car is going to be in their name and the loan is going to be in their name, which means you will not be building credit history. So a good thing would be for your parent, if they're so kind, is to add you as a co-signer on that auto loan. So that way you can build credit history. Sorry, excuse me. If you don't have a parent that's maybe kind enough to co-sign for you, something that Foothill has, we do have our first time auto buying program. And it is for individuals that maybe don't have the most credit history and they're buying their very first car, which you can look into. So we do have programs for that as well. But there's different ways you could do that. Hopefully that answers that one. That's a hard one. Wow.
He's putting you to the test tonight.
Yeah, you're making me work. I like it. We do have our auto buying for teens seminar next Thursday. So if that is something you're interested in knowing, I recommend watching that seminar. And I'm going to make a note to go into detail for that answer.
So, and I think this was the last one. Oh, and he said, thank you so much, Melissa. I think you answered this one. Would it affect your parents' credit score for authorized users?
Yes. So remember, for authorized users, it will affect your parents, but not yours. It will not give you any type of credit score. It's going to they will be able to show that you were on a credit card as an authorized user. That's going to show on your credit report, but it's not going to affect your credit score. So for me, when I did that, it was a good teaching tool that my mom, was able to watch me, make sure I did my payments on time, make sure I wasn't going crazy with a credit card. So it's a good way to practice. And then once I became of age where I could get my own and I started working, I got my own credit card, then that's where I really was able to put all of those things I learned, I could put them into play. So it's a good teaching tool, but if they want to be a co-signer, that's what's really going to help you in the long run. But like I said, even if you're starting out and you're a student and you don't have any credit history, you could still get approved for a credit card. Like I said, here at Foothill, what we're going to really look at is your income. Are you working? Do you have the ability to repay this loan? And if you're just starting out with credit, especially if you have a history with us, you have your account with us already, or you open your account with us, you have direct deposit, those factors, they're going to help to approve you. But we can tell when you're a student and you're just starting out. We can tell. So usually what's going to happen is you're going to get started at a lower limit, which in my opinion is good for you because you don't want to go crazy. But don't be scared that just because you have no credit history, that means you're not going to be able to get approved. I would go with your financial institution that you have history with because they're most likely to approve you. So if you're members with Foothill, come here for your first credit card. If you're not members with Foothill, still come here, open your account with us, because once you show that you are going to be banking with us, that's going to factor into us approving you. But it depends. But if you don't get approved, ask them why. Maybe they'll tell you, I'm sorry, you don't have enough income, or they'll give you suggestions on what to do. So don't be afraid to ask questions. That is the number one thing with young adults that I see is you're so scared to ask questions, and there's no dumb question. You guys are just starting out, you're brand new. So it's better to ask and get that answer than to assume or, to go off of somebody else's answer. It could be wrong. So don't be afraid. They know you're just starting out, so they will not, they'll be open and, give you all the details. So they're very helpful. We're nice here.
Well, that was your last question, Melissa. So great job.
Perfect. Awesome. Well, thank you guys for joining us today. Don't forget, next week on Tuesday, we have our budgeting seminar. So that one will be fun, kind of teach you a little bit more about budgeting when you are doing, when you get an income, when you're purchasing items throughout life. And then on Thursday, we have our auto buying for teens. And we'll talk about, the auto buying process. So it'll give you a good insight into that if you guys are in the market, maybe soon, maybe 3 years, maybe 5 years. It's still going to be good information for you guys. I think we're good to go, Stace.
Yep. Thank you,
Awesome.
everybody, for joining us tonight, and we look forward to seeing you guys next week. Have a great evening.